Welcome to today's webinar with me, Fawad Razaqzada. Also in the room is my colleague, Victor. We will be presenting the live market analysis webinar. Today, obviously, with the elections coming up, we are going to briefly talk about fundamentals as well. But just to give you an idea how these webinars are conducted normally, the live market analysis series is usually more about technical analysis. It is very interactive, meaning we ask people that are in this webinar to ask us questions, and we'd be more than happy to provide answers for all of your questions. And I can already see a question. Could I access last week's webinar recording? Yes, you can. It's on our YouTube channel. So if you go to our YouTube channel, it should be there. Okay, you can find it. So now this webinar, as I mentioned, I'm going to share live charts. We can discuss the markets very, in depth. But before I begin, it's important that you're aware of the risks involved in trading. So please take a moment to read through this. These webinars are for general information only and are not intended to provide trading or investment advice. Any information relating to past performance of an investment does not guarantee future performance. Think markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Now, very quickly then, for those of you who are new to this webinar, it happens every Tuesday, 11:30 London time. We are talking mainly technical analysis on major currency pairs, gold and indices, but we do touch on fundamentals as well. There'll be lots of scenarios that we mark out on the charts. For example, if a certain level breaks, what could then happen? Where is price likely to head to next? Giving you lots of information in regard to the likely direction of prices. We'll have the Q&A at the end, but as I mentioned, please feel free to ask us anything now. So the US election is just a week away now, or only 5 more trading days. And time is fast running out for US lawmakers to finish an aid package before then. Hopes over a deal had kept the market supported until now, but with the time running out, the stimulus package may have to wait until after the election. European stocks are flat today, and US index futures are higher following heavy losses the day before when stocks fell on concerns about the relentless spread of the coronavirus. Now, obviously, Europe is very close to announcing strict rules imposed during the initial wave of the pandemic. And the region's virus situation is moving towards that of early March, and some fear that the second wave will probably be worse than the first one, and that is one major concern for investors. But at the same time, there's still hope that a vaccine might soon become available, and expectations over further stimulus, not just from governments, but also from central banks. You know, we have a number of central bank meetings this week, including the Bank of Japan, European Central Bank, the Bank of Canada. Expectations over further stimulus have kept the downside limited for the time being for the major stock indices. But as I mentioned, the focus will be on rising virus cases, deaths, and lockdowns, as well as the looming US presidential election. Not to mention the Brexit related talks. So there's lots of things happening at the moment. But overall, I think the markets are still in a range band kind of direction. There's no clear direction with the stocks going sideways for the last several weeks. But in more recent days, we've seen somewhat a negative tone towards the equity indices, and in turn other markets as well. So among the key economic data or fundamental events coming up this week, I think the European Central Bank policy decision will be among the more important issues. Now, the case for further easing from the ECB has risen due to the impact of rising infections and restrictions across the Eurozone. However, it's highly unlikely that the central bank will wait. Rather, it's highly likely that the central banks will wait. The central bank will wait until the December meeting when they publish their staff forecasts. But at this meeting, any hints that they will increase the pace of their QE or cut rates further is what market observers are watching out for. So make sure that you tune in to the press conference that happens after the ECB rate decision is announced on Thursday. In terms of data, we have GDP from US. That's very important, obviously. We also have the German GDP on Friday, as well as some other key economic pointers, as you can see. This week as well, we have lots of company earnings coming up. From the UK, we've already heard from HSBC and BP today, both topping expectations. Lloyds Bank and NatWest will be reporting their results later in the week. From the US, the big technology companies, Microsoft, Apple, Amazon, Google, Facebook, they're all reporting their results this week, as well as some of the other companies mentioned here. So these results will provide us lots of volatility and trading opportunities for individual companies and possibly for the affected sectors, namely the technology sector. It will be important to pay close attention to what the CEOs of these companies say about the current situation, and more to the point about the outlook. Their views will offer fresh clues about the health of the global economy. So if we hear more pessimism from these companies, then we could see renewed falls in stocks as investors price out their bullish and optimistic forecast that they have been pricing in since markets bottomed out in March. So now let's go straight to the charts, and I'm gonna start off with the VIX index. You should be able to see it in front of you in 2 seconds. In fact, this is the euro dollar. Just give me 1 second. And the VIX is here. So yesterday, stocks fell sharply, especially in Europe, with the German DAX index falling 3.5% after results from SAP, disappointed expectations, causing the German index to fall sharply. And that led to a rise in the volatility index, the fear gauge. The volatility index has been falling after peaking in March, making lower highs and lower lows. But in more recent times, you can see that it starts to pick up again as we near the elections. So watch out for volatility to spike. And usually when the volatility is rising, it's not good news for the stock markets, which means there's elevated risk that we could see a correction in the stock markets. So that's what the VIX is showing us right now. Let me show you the major indices. I can get rid of this. The S&P 500 is holding the trend line for the time being. So the trend is still bullish, price or the index rather is above the 200-day moving average. It's making higher highs and higher lows. Recently, though, it has been coming off its highs, which is understandable given the elevated risks investors are facing. So there's been a bit of caution coming into the market in recent days. However, the longer term trend is still bullish. However, if the trend line breaks here, then that could lead to some technical selling below that level. So it is important that the trend line holds. And I think there's a similar picture across all the major indices as I go on to show you charts on TradingView. We saw the S&P 500 just now. This was the chart that you just saw. here I've also got this bearish channel. So if the index were to break above this channel, then that would be deemed a bullish development in the short term. Likewise, if you look at the Nasdaq 100, it is holding above the bullish trend line, just testing resistance around 11,560, which was the lows that gave way on Monday. So that's a potential resistance level being tested. We've also got the resistance trend of the channel coming in around that level, not to mention the 21-day exponential moving average. So there is a risk that the Nasdaq could head lower from here, especially after forming a bullish or a bearish engulfing candle, suggesting that the buyers may have lost control of price action. But we do need a break below the trend line to trigger a risk-off signal, a proper risk-off signal, in my view. Now, the Nasdaq should be watched very closely because, as I mentioned, we have lots of big technology companies reporting this week. If their results, generally disappoint, especially from the likes of Amazon and Apple, then the Nasdaq could head significantly lower from here. Remember, the Nasdaq has been outperforming all the other major indices since lockdown. But that could turn, the trend could reverse if technology companies do not provide forecasts that are as optimistic as investors are hoping for.
So just to jump in here and elaborate a little bit on this point. So basically, what we have heard yesterday on SAP's earnings call, was that they expect their business to decline over the coming quarters and on really recover in 2021. And since SAP is a major technology company, this basically served as a warning signal that we may see technology companies starting to feel the pain from basically from companies that have been exposed to the physical economy, so to say. So the moment the digital economy starts suffering from lack of demand, and obviously a lot of people are unemployed all over the world, and this trickles down to the bottom line of technology companies eventually.
Yeah, that's a good point.
And it remains to be seen whether this will affect the US technology companies, since SAP is more kind of major institutions focused. That makes it an outlier. However, we can still, there is a risk that this issue persists, and we see more technology companies reporting weaker results.
Yeah, that's a big risk, as Victor mentioned. And the reason I've brought up the German DAX index here in front of you is because SAP is the largest technology company in Europe, and it's a German company. So yesterday's results was the reason why the DAX fell as sharply as it did. But from a more technical point of view, the DAX is testing the 200-day moving average, as you can see, and it has taken out prior liquidity that was resting below these lows at 12,336 and this low here as well at 12,210. And it's bounced from there just a little bit. So let's see where it ends today. If it goes back above one of these red lines, I think that would be short-term bullish development, but it will need to create a higher high above the most recent high, which was right here. So if it goes above there, I think that would be a bullish development. So that level needs to break for the bulls to start coming back in. So in other words, we need to see a higher high before we can turn bullish on this market. Right now, it's in a wide consolidation range. So if I can draw a box here, you can see what I mean. So yeah, the DAX hasn't gone anywhere since literally the start of the summer. It needs to break in one or the other direction to encourage, technical selling or momentum selling or buying in the direction of the breakout. I can see a question. Can you do the dollar index, please? Of course we can. So let's jump to the dollar index straight away. Now, the dollar index is still bearish from a technical point of view. Okay, so it has been making lower lows and lower highs. There's a bearish trend line in place. Recently, the dollar index broke down from this bullish or short-term bullish channel, I should say. Price or the index is holding its own below the moving averages. So there's nothing bullish about it right now. However, the dollar has started to trade differently against different foreign currencies. So just because the dollar index is still making lower lows, lower highs, it doesn't mean that the dollar as a currency is still bearish. Remember, the dollar index is made up of mostly of the euro dollar. It's so it's an inverse reflection of the euro dollar mainly, rather than anything else. Speaking of the euro dollar, I think Victor was going to talk us through the euro dollar. But before I show you the euro dollar chart, just to make a few points on the dollar index itself, since you've asked me a question on it. Now, as I zoom in, you can see the dollar index making lower lows, lower highs. 93 is a key level to watch because previously it was support, as you can see here. We broke below it. Now it's being retested and it's offering some resistance. Some weak resistance, I must add, but it's providing some resistance nonetheless. Slightly stronger resistance may be around the shaded region, where we also have the bearish trend line converging. But if it starts to move above the bearish trend line, then at that point you'd have to drop your bullish, your bearish views on the dollar index, especially if it then goes on to take out the most recent high, which was this high here. So if it takes out that high, that would be a bullish development in my view, at least in the short term anyway. And that could then lead to a move back towards the range highs at 94.65-ish, possibly ahead of more gains thereafter. So that would be the bullish development. But if the trend line holds, then that's my base case assumption for now, that the trend line will hold, given the longer term bearish outlook as well. That the dollar index is most likely to head lower than higher from here, with the next downside target is the liquidity below this low here, where there will be some stop orders resting below there from people who have bought the dip, and if the trend continues downwards, those liquidity or those orders sitting right there will be taken out next, leading to a potential sharp drop towards the next level of support around 92, with the prior low coming in at 91.75, which is right here. So overall, I'm bearish on the dollar index because price action is bearish, but I'm prepared to drop that view if and when the index tells us to do that. And I think a lot of it will depend on the action or inaction of the European Central Bank this week, as well as risk sentiment. Because if risk sentiment turns sour, we will see haven flows into the dollar, because the dollar is a reserve currency. Especially, we could see the dollar do very well against commodity dollars, like the Canadian dollar, like the Aussie dollar, if stocks were to turn lower here and we enter a period of market turmoil. But we'll cover those currencies later. Let's talk about the euro dollar next. The euro dollar has been consolidating ahead of the European Central Bank meeting, which is something that Victor, I think, had a point on.
Yeah, sure. So I wouldn't only say the European Central Bank, but also the US election, because basically big investors are on the sidelines. They're waiting for a resolution, which we might not get, as we mentioned last week for some time. But yeah, the pressure points here are obviously between 1800, 118 and 1850. 118.50. The range has been firmly established between these pressure points right now, and a break to either side could see some stops getting triggered. However, I wouldn't be jumping in on any breakouts before the US election, to be honest. I don't think that the ECB's meeting on Thursday is going to be a major trigger for a breakout either way, just because they're kind of in a wait and see mode, and the way that they can help the European economy right now is through basically fiscal policy, and we don't even have we haven't even started seeing the effects from the last fiscal package that the European European authorities authorized in I think June.
Right.
So yeah, there is still a lot of disputes on who should get what money, and that's kind of slowing down the recovery process. We are also seeing an exponential jump increase in the cases of coronavirus across Europe.
Yeah.
And since the European economy is much more dependent on these on tourism flows and on the coming holidays, could be also very negative for the European economy, because typically it's being viewed as a holiday destination. A lot of people are not going to get that income, so they'll be spending less money all across the economy. So
yeah,
these are major risks for the Eurozone, and we can't really see this changing anytime soon, just because the coronavirus situation is unlikely to get any better.
But it's not reflected in the price action yet, is it? These macro concerns. I mean, the Eurodollar is still printing higher highs and higher lows.
Yeah, I don't think that it's reflected just because people are waiting for the US election. And obviously we're going to need to see whether we're going to get some fiscal policy response from the US.
Yeah.
And at that point in time, when we see where we are with the new president, or the old president for that matter, or and Congress, the Senate.
The Senate, yeah.
Which is in play, widely in play. So the moment we get clarity on that front, and if we get a Democrat administration with a Democratic Senate, this could mean a lot more downside for the US dollar. However, I want to warn everyone that has a view that you need to be you need not to be married to your view at this point.
Absolutely,
that's
really
wait
important.
it out and see what happens.
Obviously, that doesn't mean you can't trade the Eurodollar short term. Zooming in onto the hourly or smaller time frames. Trade the range bands from
ranges are in place.
Yeah. Do you have any kind of level that you think if it breaks, it's going to lead to a breakdown or a breakout on the Eurodollar?
So if we're speaking short term, I would be playing the range, meaning that I would be buying below 118 and selling above 118.50.
Okay.
Yeah.
So that's very tight range. Okay. Going to an hour. Let me get rid of this. Hold on. 1 hour.
Yeah. So if you go in on the hourly chart, I really can't see us going much higher than 1870 and much lower than 1790 at this point in time.
Yeah, 1790. So, yeah, it's proper range band market.
So I would be playing the range until the election. I don't think it's going to break one way or the other into it.
Even if it breaks, it could do something like this, for example. Break the hold on. Let me just get the drawing tool out. It could break the top of the resistance and then consolidate there for a while and then go back inside. Make it extremely challenging to trade. So could play both sides and then go back, something like that. Is very typical of range band conditions. You'll get lots of false breaks and false breakdowns. So be wary of that. Especially around highs and lows, because that's where a lot of people will get trapped in the wrong side of the market. But if we zoom out a little bit and talk on the daily chart, there's lots of macro concerns, yet the price action is still somewhat more bullish than bearish as things stand. Indeed, every time it looks like price is about to head lower, it continues to do the opposite. For example, we had a bullish channel here a couple of weeks ago. This was the bullish channel. Price broke down below that. Once it broke down, it looked like it was going to head sharply lower from there. It didn't. It went up again. So that kind of trapped the sellers. Yet the upside as well has been very limited. For example, every time it breaks through something like for example, this bearish channel, it broke out of this on the upside. Look how limited the upside was before price came back down to retest the upper side of the trend line and bounce from there. So, another break can be from this. If I draw the trend line here, notice how small the continuation to the upside has been. So this kind of underscores Victor's point of view that ranges are dominating price action, meaning that if you do trade the euro dollar, keep it short term, trade the smaller time frames from one level to the next and move on to the next opportunity.
And make sure to visit our webinar into the US election next week to know more about our thoughts on what's about to happen.
Exactly. Yeah.
So one last point that I wanted to make is basically that we have been in a tight range since the beginning of August, and this basically has been about 4 months of hovering around 1800 or thereabout. And this the moment this range breaks, we're going to have a significant move. So don't try to find the tops or bottoms once we break out of this.
Some people try to get in a position before the breakout. I mean, there's nothing wrong with it if you can manage it properly, but easier trades, the low hanging fruits, so to speak, will come once price starts to trend in a particular direction. Yes, you will probably miss the absolute top or the absolute bottom, but in terms of risk to reward, you'd probably get better trades and less emotionally draining trades than what you would right now, especially on the euro dollar.
Certainly.
Let's talk about a few other markets, and I want to spend some time on the yen, dollar yen, and some other yen crosses if we have time. Now the yen has been quite tight compared to all the other dollar pairs since the height of the coronavirus in March. The dollar has been falling across the board, but against the yen, it has been trading in very tight ranges. Now, that could be about to change as uncertainties regarding elections, coronavirus, and whatnot start to change and increase. And the Japanese yen is a haven currency. So I think going forward, at least until election days, I think the dollar yen or the yen as a currency is going to strengthen, causing the dollar yen to potentially fall. And right here, we have a daily chart of the dollar yen. As you can see, price has been making incremental lower lows and lower highs. So the pressure is kind of building for a potentially big breakdown. Recent price action has been bearish. Last week, we formed this large bearish looking candle. And this week, we went back up to retest the 105 area, which was previously support. And price has reacted from there. So from here, it looks like the dollar yen is heading lower. And the first target would be liquidity resting below this low. That's where the trapped bulls stops are going to be resting. So people who have bought the dip, their stops are going to be resting there, most likely. And some of those stops will be resting below this low, meaning that these areas are effectively pools of liquidity. And when you have liquidity resting below certain levels, the market is a function of liquidity. It moves from one area of liquidity to the next. And so with that in mind, I think the dollar yen is heading below this low initially and possibly below this low thereafter. I have a couple of Fibonacci-based targets as well that you could possibly aim for if you're trading the dollar yen on the short side. If you're waiting for a bullish breakout, I think it's important to get a proper signal. So far, all the bullish signals have proven futile. I think if we go above the bearish trend line and this recent high at 105.75, I think that would be bullish in the short term outlook. So if you're looking for long opportunities on dollar yen, perhaps waiting for a proper bullish signal should be ideal. Otherwise, I think the trend is still bearish, even if it's not a strong trend. Let's talk about the pound very briefly, because you did talk about the euro. The pound has been trending higher. Most recently, it has been consolidating in narrow ranges, around the 130 handle. It went up as high as 131.50, and the low of the range has been around 128.50-ish. But it's holding its own relatively well, given all the risks concerning coronavirus situation in the UK, Brexit, etc., etc. Despite all of that, the pound is doing okay, and supports have been defended. 130 is obviously a key level, a psychological level. Notice how this level has been has provided lots of bounce, both on the downside and on the upside in the past, as I show you here. And the latest bounce has come from this level once again, as you can see from this daily chart. After a 3 or 4 day sell-off, it's hardly surprising to see a bounce at support. These are the arrows that you can see on the chart. I had drawn them, several days ago, weeks even, and they remain valid. So the bullish scenario is a bounce from 130, which is underway right now. And I think this could lead to a possible rally towards the top of the range around 130, 140-ish. And what happens after that, who knows? If we get a daily close above that level, so if there's acceptance above 130, 140, that would be bullish. And that could then pave the way for our extended bullish scenario, meaning that any rounded retest of 130, 140-ish or 130, 150 level could be defended in the future, leading to a possible rally towards and above this year's earlier high and the 2019 high as well, which was this high here. Meanwhile, in terms of bearish scenarios, we need a proper breakdown. Okay, so there is a trend line here. At this level, this trend line needs to break first and foremost before we turn bearish on the pound. But more to the point, we need to see price take out the last low prior to the latest rally. So if that level breaks this right here at 128.55, if that level breaks and there's acceptance below that level, then any rounded retest of that could see rates drop to take out liquidity resting below the next low right here at 126.75-ish. So those are the two kind of, or the three scenarios that we're looking at right now on the pound. As the pound is looking somewhat more constructive than the euro pound is therefore looking a little bit bearish right now. Now, I have drawn this channel intentionally this way rather than connecting this high. The reason I've connected these highs is that prior to the breakout or the false breakout, that channel looked more constructive, right? When the euro pound rather broke above this channel, this level right here, let me just color that in blue. This blue level should have held as support, right? Because that was the breakout level. Price came back down, retested it. It should have bounced from there. It didn't. It collapsed, taking out the most recent low. What's happened since is price has come back up all the way to retest that level where people have been trapped. Now they are evidently closing out their losing long positions right there. That's why price has started to come back down. And you can see that more cleanly on the hourly chart. Do I have an hourly chart? Yeah, that's the hourly chart. Right there. So that level should have held, didn't retest, offered some resistance. We went up to retest that level once again yesterday, around 91. Once again, it offered resistance and price is holding below it. So the euro pound is looking bearish to me. And unless we go and close back above the 91 level. So if we close on a daily basis above 91, that would be bullish. Right now, this level is offering resistance. So the path of least resistance is to the downside for the euro pound. I can't see any questions, guys. Come on. We've got a few minutes to spare with you guys. If you have any questions on any markets we haven't covered, please feel free to ask.
I'm surprised you haven't touched, you haven't said anything about gold.
Gold. Let's talk about gold. Well, the thing is, there's not much to talk about gold, unfortunately, right now. It's been so boring in the last.
So choppy.
Yeah, it's really been going nowhere, absolutely nowhere. Because on the one hand, you have the dollar weakening a little bit, which should be positive for gold. But on the other hand, if you look at yields, in recent weeks, yields have been going up. So bond prices have been going down, which is not very positive for gold. However, that said, this is the 10-year US yield. You can see that yields have come off the 200-day moving average, which is potentially bearish scenario. The longer term direction of yields is obviously bearish to the downside because of all the actions of central banks. So if this is the resumption of the downward trend, then possibly that would be a bullish development for gold. But from a purely technical point of view, gold has been really frustrating, to say the least. This is the 2011 record high. If I show you this on the weekly chart, where are we? Maybe even the monthly, because it's easier. This was the record high that was hit in 2011. Gold has rallied right into that level. We broke through it, touched the psychologically important 2000 level, and then we've kind of failed to hold there, and gold has broken down. We've gone back below the 2011 record high, and it's kind of consolidating below that right now, which is not particularly bullish. So, from a bullish point of view, we have broken lots of these trend lines, but there's been no upside follow through. So what I'm waiting for now is literally a decisive move higher before turning positive on gold again. Specifically, I want to see gold go back above that 2011 high, and also this high here. This was the most recent significant high at 1974. So that level needs to break to create a higher high, a distinct higher high, right? If that were to happen, then I think the path of least resistance would become to the upside again, and we could see a new all-time high for gold. In contrast, if we go back below this black line here, which was the August low, we may have formed a false break below that level right here. But it's not confirmed by, as price hasn't broken the most significant higher high yet, the most significant swing high yet. So this there's a question mark here, whether this was a false break, which is a bullish reversal pattern, or this is a breakdown in market structure, meaning that the prior higher highs and high lows have broken down here. So if gold were to go back below this black level here, that would be bearish. And I think that would then clear the way for a possible drop to 1800, maybe even lower over time. So yeah, that's my views on gold. Do you have anything to add on gold, Victor?
So basically, it's at this point in time, I think we're coming to the battle of the safe havens.
Indeed.
What is safer? What is safer to own? Gold or the stocks of major US technology companies?
Yeah.
And I have to say that for now, it seems like it's a draw.
Yeah.
Although, depending on which companies you're holding, because some companies have risen in value way more than gold over the past 6 months, and but still, like we have seen peaks in both asset classes, and ultimately, not some money, a lot of money is going to be moved from one into the other.
Yeah.
And when that happens, we're going to have a significant move lower or higher. So I can't give you any advice. I just want to make you aware of this fact that gold is not the only safe haven in the 21st century.
Right, that's something.
Major technology companies that are, an alternative, that provide an alternative, and as you have heard many times, I'm sure the age of big tech is merely beginning. Be wary of that.
Also, Bitcoin, Bitcoin fanatics will say that cryptocurrencies offer alternative haven assets to gold. So that's another thing. But yeah, coming back to your technology companies point, Victor, obviously, those companies can potentially go bust, but gold can never go bust, right? so there's that, which is why I think gold is the ultimate safe haven.
Well, it's
asset long term.
It's not like as long as people value a piece of metal more than their iPhone, then yes. However, I would question this narrative. Like, we might be getting to a point where the iPhone is more precious.
It certainly is to me. That's a fair point. That's a fair point. It's all what do the markets perceive something to be more haven than something else. It's not necessarily what I or Victor think, it's what the markets think. And right now, as Victor mentions correctly, technology companies have been rallying. Obviously, they come with higher risk and potentially higher reward, but that's another point. There's another question, says Hassan is asking, what is the easiest forex pair to trade? I think if you mean in terms of volatility, then euro pound is less volatile, for example, than the pound dollar. Is that necessarily an easier market to trade? No. That depends on your trading strategy, your trading style. Some people find it easier to trade highly volatile markets than lower volatile markets. So there's no such thing as easy market to trade. But if you mean if something is trending to trade, perhaps you are trend following, you have a trend following strategy, then you could, for example, look at things like this. The Turkish lira has been collapsing, right? And the dollar against the Turkish lira has been rising. So this is among one of the trending markets, possibly making it easier to trade on the long side, but it's not risk-free. Nothing is, it's equally as risky as the other major currencies to trade, currency pairs to trade. So, that's the answer I can give you. It really depends on what you mean by easy. Nothing is easy.
Yeah, well, if I can, exactly, if I can just jump in, there is no easy forex pair to trade.
Yeah.
You
got to have a strategy. Are you, do you trade ranges? Do you trade with the direction of the trend? I think generally speaking, just I'm going a little bit off point here, but I want to make a point. To make it easier to trade, I think newer traders should trade higher time frames, like the daily rather than the hourly or 15-minute charts. Okay, so that's one thing. With the daily, you filter out a lot of intraday noise, meaning that you won't get stopped out easily by price spikes. You will remain in the trade slightly longer. Yeah, slightly longer than you would.
So yeah, well, Hassan, if you think that like it's easy to read a currency pair that is not trading in a range, that's much easier than the choppy euro dollar, for example, right now.
Exactly.
Which can make you go crazy. Like it basically constantly tricking you into changing your opinion of it.
Yeah. I think out of the currency pairs we've talked about, I think the dollar yen is easiest to read right now because of the fact that it's been trending somewhat, obviously less strong as the Turkish lira is, but in terms of a major currency pair which has low spreads, and it's the dollar yen in my view. It's to me at least anyway, it's easy to read because every time it's going up, it's gone up, it has been rejected. So it's a bearish trend so far. You find trading the euro dollar very difficult. Yeah, so that's why exactly underscores Victor's point that because right now the euro dollar is in a range, it's very difficult to trade it. Especially if you look at this on a
if you go on an hourly chart and look at the euro dollar, it's being constantly like you have a break of a level, then a pullback that kills you, and then it happens on the other side. So
look, to underscore Victor's point, you know, you had a level right here, price breaks above it, fails, boom, goes down. Then you find support here, breaks below it, doesn't hold, goes up. Then it finally breaks down and it goes down. That's getting everyone short on the euro. Before you know it, we are back above this level and it goes up again. And the same cycle repeats. So find a market that's trending. That's the key. Okay, find a market that's trending. If nothing is trending, don't trade. You know, just wait. Opportunities will come. But always, in my view, unless you're a range bound trader and you know what you're doing, for the most part, for most people, I think trending markets are a lot easier to trade in the direction of the trend, that is, okay, than range bound markets. Yeah. Unfortunately, not many markets are trending right now because of the
clearly, like if you wanna find a trending asset, perhaps focus on single stocks.
Yeah,
and maybe just for a time, just leave the FX market to get resolved by the US election, and jump back in, stand ready to jump back in at any point in time, because right now it's obviously very, very hard.
Yeah, I'm just looking at the major currency pairs. Everything is literally in consolidation. So as Victor said, look elsewhere if you're a trend following an analyst or trader, or you could obviously trade very short term, which is riskier. You need to be very comfortable trading that way. But if you want to learn to trade really short term, like on the 15 minutes or an hour chart, then what you need to do is perhaps reduce your position size such that it's like less than half of what you would normally trade in terms of size. I can't see any further questions, and we've run out of time, guys. So let me thank you for joining us. The recording of this webinar should be available for a limited time on YouTube, possibly later on today, maybe for 1 week or so. And so if you want to watch this again, it will be there, hopefully. But we will be back. We will be back on the November 3rd for the US election special. Victor will be leading that webinar. I think we'll have our colleague from Australia, Carl, who will be joining us as well. Then on the 6th of November, we have the non-farm payrolls webinar, the preview for that jobs report. And I'll be leading that webinar. It all starts same time as this one, 11:30 London time. So please make sure to join us for that one. And this type of webinar that we had today is going to repeat every week after the November election webinar, November 3rd election webinar. So make sure you spread the news, share the links with your friends and traders, so we can get more people come into these rooms and encourage us to deliver the type of content that we want to deliver for you guys. Because the more people there are, the easier it is for us, because it encourages us. The people will be asking more questions, and we'll be discussing more markets, and more time will be spent as well. So thank you so much. Have a lovely week. Please be careful out there. Don't chase anything. Be nimble, trade from one level to the next. And hopefully we'll see you guys next week. Take care.
See you next week. Cheers. Bye-bye.